Ever wondered how your emotions might be ruling your financial decisions? Let's delve into the world of emotional decision-making. Picture this. The stock market takes a sudden plunge. Fear creeps in, triggering a hasty decision to sell stocks to prevent further losses. This panic selling, while seemingly a protective measure, can lead to missing out on potential rebounds when the market recovers. Now let's flip the coin. Picture a bull market where stocks are soaring and optimism is in the air. This euphoria can breed overconfidence, nudging you to invest more than you can afford to lose, banking on the hope that the uptrend will continue indefinitely. But remember, what goes up must come down. When the market corrects itself, these reckless investments can lead to significant losses. In both scenarios, fear and greed, two powerful emotions, are at play, steering financial decisions. They can push us to act impulsively, often without considering the long-term consequences of our actions. And while it's completely natural to have emotional reactions to market fluctuations, it's crucial to recognize their potential to cloud our judgment. Emotions unchecked can be our worst enemies in the financial world. They can lure us into making hasty decisions that we might regret later. So the next time you find yourself caught in the grip of fear or greed, take a moment to step back, breathe, and think logically. So, unchecked emotions can lead us to make hasty and often regrettable financial decisions. Are you only hearing what you want to hear when it comes to your money? Let's imagine an investor named John. John is a strong believer in the potential of a particular technology stock. He's read all the positive articles, watched all the bullish forecasts, and is convinced that it's the next big thing. But here's the catch. John is so invested in this belief that he's ignoring any information that contradicts his viewpoint. Negative reviews, concerns about the company's financial health, or even market trends that don't favor his chosen stock are shrugged off. This is what we call confirmation bias. Confirmation bias is an innate human tendency to seek out information that supports our pre-existing beliefs and to dismiss information that challenges them. When applied to financial decisions, like in John's case, it can lead to a dangerous lack of balance. By only paying attention to the information that confirms his belief, John is missing the full picture. He's not considering the potential risks associated with his investment. This one-sided information gathering can lead to poor investment choices. It can cause an investor to double down on a losing bet, or miss out on opportunities to diversify their portfolio. It's like trying to navigate a ship with a compass that only points in one direction. Confirmation bias then can trap us in an echo chamber of our own beliefs, leading to financial missteps. Do you fear losing money more than you enjoy making it? This question brings us to the concept of loss aversion, a fundamental principle in behavioral finance. Imagine this. John, an amateur investor, has a golden opportunity to invest in a promising venture. The potential for high returns is enticing, but the risk of loss looms large. Despite the favorable odds, John chooses to sit it out, haunted by the specter of potential loss. This is a classic demonstration of loss aversion. Humans by nature are wired to dread losses more than they relish gains. The pain of losing £20 feels much more intense than the joy of winning the same amount. This bias in our emotional response can often skew our decision-making process, making us overly cautious and risk-averse. In the realm of finance, this fear-driven behavior can prevent us from seizing lucrative opportunities and taking calculated risks that could catapult our wealth to greater heights. Loss aversion can keep us stuck in a financial comfort zone, hindering our wealth growth. Do you find yourself following the crowd when it comes to investing? Picture this. A savvy investor, let's call him Jack, has done well so far, but he hears whispers of a new hot trend that's garnering the attention of the masses. He's tempted, and without much thought, he jumps on the bandwagon. He's now part of the herd, one of many investors swayed by the buzz and excitement of a booming market. But here's the kicker. This herd mentality can inflate the value of assets beyond their actual worth, creating what we call a financial bubble. And what happens to bubbles eventually? They burst. When that happens, Jack, along with others who followed the crowd, suffers the brunt of a crashing market. It's a simple story, but it underlines a complex truth. Herd behavior can lead us into financial pitfalls, swept away by the tide of popular opinion. Are you playing the long game with your finances, or are you caught up in the moment? Let's imagine two investors, Alice and Bob. Alice is prone to making impulsive decisions, swayed by the daily ups and downs of the market. She buys when prices soar and sells when they dip, driven by her emotions rather than a solid strategy. On the other hand, we have Bob. Bob adopts a long-term perspective. He carefully crafts a diversified portfolio, takes calculated risks, and stays the course, regardless of market fluctuations. He understands that the market is like a roller coaster ride, full of highs and lows, but he knows that over time it trends upward. Over the years, Alice's portfolio sees a lot of activity. She's constantly buying and selling, trying to time the market perfectly. But this strategy often leads to more losses than gains. The stress and anxiety of constantly monitoring the market also take a toll on Alice's well-being. Bob, meanwhile, experiences the same market fluctuations. But instead of panicking when prices drop or getting overly excited when they rise, he remains calm and collected. He sticks to his strategy, knowing that it's designed to weather the storms and take advantage of the sunny days. As time goes on, Bob's portfolio grows steadily. He's not making a fortune overnight, but his wealth is accumulating, little by little. Alice, on the other hand, finds that her portfolio is barely growing, if at all. Her impulsive decisions, driven by short-term market changes, have hindered her wealth accumulation. This tale of Alice and Bob highlights the importance of adopting a long-term perspective when it comes to investing. It's not about making quick wins or avoiding short-term losses. It's about understanding that building wealth takes time, patience, and strategic planning. It's about staying the course, ignoring the noise, and focusing on your long-term financial goals. In the end, maintaining a long-term perspective can serve as our compass, guiding us towards sound financial decisions and sustainable wealth growth.